I still remember my first investment, a life insurance policy, a unit-linked one to be precise. Now at that time I had little idea about investing and I wanted to make a tax-saving investment. Time was running out. So this ULIP policy was a real godsend. I was happy that I saved taxes and I also felt I got to invest in a product that is like a mutual fund with an insurance benefit. But when I started studying investments, I realized that I have made a mistake. This ULIP policy had high charges, wasn't transparent, and the life cover was not sufficient. I eventually exited the policy after its lock-in period ended and heaved a sigh of relief. But I lost part of my invested capital in the process. Now I'm sure I'm not alone in this experience. Many of us have life insurance policies that we don't need, about which we don't know enough, or that we want to quit but don't know if we should. Now if you also fall in any of these brackets, this video is just for you. Hello and welcome to ET Money's YouTube channel. Now many of us end up with life insurance policies that shouldn't have been brought in the first place. The reasons are many: lack of awareness, tax saving, mis-selling, obliging, or the simple inability to turn down a relative, a friend or a neighbor. Now such policies which have been purchased without much thought, purpose or analysis can prove to be a serious drag on your finances and must be dealt with appropriately. And this video will help you do so. But before we begin, let's take a quick pause and talk about something that's closely connected to this topic: making smart investment decisions. Because just like choosing whether to keep or surrender a life insurance policy, investing also comes with its share of choices and emotions. Take April for example. It started with negative 5.78% drop in the markets as harsher than expected tariffs triggered broad-based selling in India and across global markets, followed by a sharp 6.5% rebound in just 8 days. And by the end of the month, markets were up 3.64% thanks to low inflation and a rate cut from the RBI. And it wasn't just April. Over the last few months, we have seen markets go from all-time highs in September to falling 18% and then rising again by 10%. Now, through all these ups and downs, ET Money Genius has been making allocation decisions that allowed investors to navigate these markets worry-free. What did it do? To know the answer, tap on the link in the description. Okay, now back to our topic. One thing you need to keep in mind is that we are not suggesting that all traditional and unit-linked insurance policies are bad, but it's important to separate the wheat from the chaff. Now this video belongs to our insurance playlist. If you'd like to watch such more videos, you can explore it. The link is in the description. Now this video is divided into certain sections for ease of comprehension. We will start by examining how to assess the usefulness of life insurance in general. We will then examine how to calculate the returns of traditional insurance policies. Then we will see the surrender options for traditional policies and ULIPs. Finally, we will discuss the important things you need to keep in mind while surrendering your life insurance. Okay, let's begin with the first section. Now, before you think of surrendering your life insurance, it's important to assess its usefulness in your individual case. A good point to start is to ask yourself if you need it. Let me explain. Life insurance is meant to protect your loved ones from life's uncertainties. So if you have financial dependence, you need life insurance. Now do note that operative phrase here is financial dependence. If you provide for your family members and they depend on you financially, they are financial dependents. However, not all loved ones may be financially dependent on you. For such dependents, you don't need life insurance. Now another related mistake that many people make is that in place of buying life insurance in their own name, they buy it in the name of their children, on whom they are not financially dependent. While doing so may be emotionally appealing, from a financial standpoint, it doesn't make sense. The right thing to do is to buy life insurance in your name so that your children's future is secured. Now the next thing you need to check is the type of life insurance you have. Broadly, there are 5 types of life insurance policy. There is term, there is whole life, endowment, money back and ULIPs. They each serve a different purpose. Term plans are the simplest life insurance. They provide you with large cover at low prices. A whole life insurance policy is meant to last your entire life and then leave a legacy for your nominees. An endowment plan and money back life insurance also double up as low risk savings instrument. And a ULIP is meant to be wealth building instrument. Now we've discussed each of this in detail in one of our earlier videos. You can watch it later for better understanding of the types of insurance. The link is in the description. But why is understanding this important? It matters that if you had certain expectations from your life insurance and bought a different product, you may want to exit the wrong product. Now, the third factor you should consider is the number of policies you have. This is important as managing a large number of policies can be a big hassle. Not only is it a hassle, but it is also a recurring financial commitment as you have to pay regular premiums to keep these policies alive. So, if you have too many policies, you may want to exit a few to simplify your portfolio. The fourth factor is buying life insurance as a tax saving option. For many policyholders, their life insurance policies also serve as tax saving avenues. However, with the sweetening of the new tax regime, this benefit is fast becoming irrelevant. But in any case, you should not be buying life insurance just to save tax. Tax saving is an additional benefit of life insurance, not a primary one. So, if you had bought life insurance only for tax savings, it's time to evaluate whether you need it now or not. The fifth point to pay attention to is the cost structure of your life insurance policy, especially ULIPs. Now, ULIPs that are sold offline through agents often have high charges. These charges are split across multiple heads such as premium allocation charges, fund management charges, policy administration, etc. But there are good ULIPs too. These are often available online and have only a single fund management charge. They are economical and compare well with mutual funds. So if you are invested in expensive ULIP or life insurance and the costs are eating into your returns, you may want to switch to a cheaper ULIP by surrendering the former. Sixth, if your life insurance policy also doubles as a savings plan and the returns it is generating are quite low, you may want to exit it. But the biggest question is, how do you know the returns from your life insurance policy? Well, we'll discuss this in the next section. But before that, do subscribe to the channel if you aren't already a subscriber and press the bell icon so you never miss a video from us. The returns from life insurance policies can be divided into two categories, market linked and non-market linked. Now, the returns from ULIPs are market linked as the money is invested in the stock market. For ULIPs, your returns would depend on the insurance plan, the charges involved, your investment preference, and so on. Now, you can check the returns your ULIP has generated so far and assess if they are okay. If they are not, you can then check the investment preferences and the fund performance. You can also take a look at the ULIP charges. On the other hand, the returns from traditional insurance plans are non-market linked. So here, you will need to get an idea of what returns an insurance policy is generating. Now, traditional insurance policies come in all shapes and sizes. So your actual returns will depend on the insurance policy, the plan type, policy term, and your age. Now, the age at which you start contributing matters, as the later you start, the more the allocation to the life insurance component and less to the allocation to the savings component. However, it would still be helpful to keep in mind a fundamental framework of return calculation from traditional insurance. Generally speaking, in traditional insurance plans, you may pay a certain premium for a certain number of years. The policy provides you with a death benefit and a maturity benefit. The death benefit is what your nominee would get in your absence, and the maturity benefit is what you get when the policy matures. Now, in the case of participating policies, you also get bonuses which are added to your final corpus. In the case of non-participating policies, there are no bonuses, but the final returns are guaranteed. Now, the payout on maturity can be either a lump sum or spread out over a period of time. Some money back policies provide periodic payouts even during the period you are paying premiums. Now, if you know the payout amounts, you can get an idea of the returns your policy is generating, regardless of the type of payout. Now, you can find this information in the policy brochure or sales document. Once you know the values, you can calculate the returns from the policy using the XIRR function on Excel or Google Sheets. The XIRR or Extended Internal Rate of Return function helps you calculate the aggregate returns of a life insurance policy where premiums are paid over time and payouts are received in lump sums or over time. Okay, let's understand this with three scenarios. In the first scenario, let's say you paid premiums of 1.5 lakh per year for 15 years and got a payout of 40 lakhs in the 16th year as a lump sum. Now, by entering the premium payments with a negative sign and the final payout with a positive sign, you would get this table on your screen. Here, we assume the premiums were paid at the start of the financial year. Now, after you enter data like this, you can use the XIRR function on Excel or Google Sheets and select the cash flows and dates to calculate the returns from your insurance policy. From the data we have considered, the XIRR is 6.9%. In the second scenario, let's say this policy provides a guaranteed payout for multiple years and a lump sum at the end of the tenure. The premiums are 1.5 lakh per year for 15 years. Then for the next 10 years, you get a fixed payout of 2 lakh rupee per year. And at the end of 10 years, you get a lump sum of 20 lakh. On the face of it, this appears to be a tempting proposition. However, the XRR from such a policy would be measly 3.8% per annum. Now compared to the first scenario, this policy also pays out 40 lakh, but in a staggered way, which is why these returns are much less when compared to the time involved in delivering them. Finally, in scenario 3, let's consider a policy that also pays lump sum, but every 5 years of the policy term. The premiums paid are the same 1.5 lakh per year. The periodical payouts are 1 lakh each, and the final payout is 38 lakh. Overall, you can get the same 40 lakhs. The XRR of such a policy is about 7.4%, and it is the best among the three. Now, this is not to suggest such an insurance policy will always be better than the other types. It will depend on the premiums and payouts and when they happen. So you can check your life insurance policy brochure or sales document, or speak with the agent or customer service of your life insurance company to get an idea about your policy's XIRR. Naturally, if your policy's XIRR is low, say under 6%, you may want to surrender it, subject to other factors that we will discuss soon. Now one more thing. For participating policies, that is those with some sort of bonus that depends on the insurer's discretion, you may not know the bonus payouts in advance. To account for bonuses in your XIR calculation, you can take a look at the past bonuses and make an estimate. Okay, let's now see specific rules regarding to surrender of ULIPs and traditional insurance plans. Now, depending upon the general usefulness of life insurance to you and the returns your traditional insurance policy is generating, if you want to quit it, you have two options. First, you can convert your policy to a paid-up plan. Second, you can surrender it. Let's explore the first option, that is the paid-up option. A life insurance policy turns into a paid-up policy if you stop paying premiums on it. When a policy becomes paid up, its life insurance coverage reduces and it continues to earn some returns. However, bonuses and guaranteed additions may not accrue. Also, do know that for a policy to become paid up, you should have paid a minimum number of premiums. Now, when the policy matures, you get the paid up value, which is calculated by the formula on your screen. For instance, you buy a policy with a sum assured of 10 lakh for 20 years with a premium of 30,000 per annum paid for 8 years. Now, as shown in the table and based on the formula we just saw, the paid up value of maturity will be 4 lakhs. But this is just an illustration. The actual value of a paid up policy will depend on how the insurance company calculates it. Some insurance may also add a portion of bonus to paid up policies too. For instance, consider LIC's Jeevan Lakshya policy, an endowment insurance plan. This policy becomes paid up if at least 1 year's premium are paid and the subsequent premiums are not paid. Now, when it becomes paid up, the death benefit becomes 110% of the basic sum assured multiplied by the ratio of number of premiums paid and the number of premiums payable. The sum assured on maturity becomes the original sum assured multiplied by the same ratio. The applicable vested bonuses are also payable on the due date of maturity. Now, let's talk about the second option, surrendering the policy. Now, when you surrender the policy is immediately terminated. You will get a percentage of premiums paid depending on the policy terms, but whatever you receive, expect it to be less than the total premiums paid. Also, if you surrender a policy within a specified period of buying it, you may not receive anything back. So do keep this in mind. Now, this duration could be 1 year or 2 years or 3 years, depending upon the policy terms. For instance, again consider LIC's Jeevan Lakshya policy. Now, as per the sales brochure of this policy, it can be surrendered after the completion of the first policy year, provided 1 full year's premium has been paid. However, the policy acquires a guaranteed surrender value or GSV after the payment of at least 2 full year premiums. This GSV is equal to the total premiums paid multiplied by the GSV factor as given in the table in the sales brochure. For instance, if the policy term is 13 years and the policy is surrendered after the second year, the applicable GSV factor is 30%. So you'll get back 30% of the total premium paid. Now, this GSV factor keeps going up as the number of years increases. This policy also provides part bonuses on surrender as per the mentioned criteria. Now, apart from this policy also has a provision for a special surrender value, which is reviewed annually in line with the IRDAI's directives. Now, these are general rules regarding paid up and surrender options. If you're not sure which one to opt for, a few general guidelines can help. First, If you bought the plan just a couple of years ago, you can think of surrendering it. Yes, you will not get anything back, but then you won't be tied up to the plan for the rest of the tenure. The money that you would have invested in the plan can be deployed in a better avenue that can also help you reduce your loss from the surrendered policy. Second, if you don't want to pay the premiums but want the policy to continue, you can opt for a paid up plan. Third, the paid up plan option is better for you if you want to avoid any loss or if the policy maturity is just a few years away. Fourth, if your policy is nearing maturity, avoid both surrendering it or turning it into a paid up plan. Just wait for the policy maturity to arrive and continue to pay the premiums in the interim. Fifth, you can ask your insurer to provide you with both the surrender and paid up values of your insurance plan, and then you can compare the two to make your mind. Okay, let's now discuss the rules related to the surrender of ULIPs. ULIPs come with a 5-year lock-in period, but you can very well surrender them during the lock-in period. Now, when you surrender a ULIP within the lock-in period, your life insurance benefits gets cancelled and the accumulated corpus is moved to a discontinued policy or DP fund until the lock-in period gets over. Take a look at the sales brochure of LIC's Nivesh Plus policy, which is a ULIP. It says that on discontinuing your policy before the lock-in period, the corpus gets transferred to the discontinued policy fund after deducting discontinuation charges. In the DP fund, your corpus earns a return of about 4% per annum. IRDAI declares this rate from time to time. A similar thing can be seen in LIC Nivesh's sales document as well. If you discontinue your ULIP after the lock-in period, you are paid the fund value of the units in your ULIP plan. If you're not sure whether you should surrender your ULIP before or after the lock-in period, some general guidelines may help. First, if you have paid premiums for just a year, you can surrender the policy. That will free up your remaining premiums and they can be invested in better revenues. But do remember that ULIPs often have high charges in the first year. So when you do so, expect to get only a small amount back post lock-in. Second, if you surrender your ULIP before 5 years, the amount you will receive after the lock-in period will be taxable as per your applicable slab rate. Also, if you had claimed any income tax deduction on the premiums, they will be nullified. Practically, you may get nothing back. Third, if you have paid premiums for 2 years or more, it may be sensible to continue the ULIP until its lock-in period gets over. They'll help you retain your tax benefits and possibly get back more after the lock-in period than surrendering the ULIP. Of course, your life cover also remains intact during this period. Fourth, if you have paid premiums for 5 years or more, you can decide whether you should exit the ULIP based on its performance. But do not hear that after 3 to 5 years, ULIP charges come down. So that's favorable for you. Now to know more about ULIPs, you can check our related video. The link is in the description. Finally, let's see a few things you need to keep in mind while surrendering your life insurance policy. The decision to surrender your life insurance shouldn't be taken in isolation. It's desirable to consider its related aspects as well. First, before you surrender a life insurance policy, do ensure a backup is in place. Surrendering a life insurance policy nullifies all its benefits, which also means that the life cover provided by it is no longer there. As a backup, you may want to invest in another policy first or get term insurance. Second, do consider that getting a new life insurance policy can be more expensive too. That's because as your age increases, so do the premiums required for the given sum assured. Also, with increasing age, the component of life insurance in your policy goes up and the savings component falls. Third, some people may find it difficult to get a new policy given their health conditions. In such a scenario, it's better to continue with the existing one. Fourth, if you surrender your policy, the tax deductions may be nullified. As we discussed, the applicable time duration for traditional policies is 2 years and for ULIPs it's 5 years. And with this, we have come to the end of this video. I hope you found it useful and it will help you make the right decision for your life insurance policies. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.